guys, welcome to our house ready videos. My name's Casey with Austin Credit Care. This is Tasha Green with Go Green Realty. We are bringing you guys videos on how to get ready to buy your first home if you haven't gone through this process before. We're going to cover both the credit aspects of it, and we're going to be covering the mortgage side of it and the home buying itself. We're going to bring you guys a bunch of valuable stuff. So if this is something that you would find value in, if you're looking to own a home, consider subscribing and following us, because we're going to be bringing these to you every week, every Thursday. And let's just jump right into it. So today, one of the things we wanted to talk about is just kind of the different types of mortgages, because you really don't know. You want to go buy a home, but you don't know what a mortgage exactly entails, and that's like really what is the scary thing in the beginning, is like figuring out what a mortgage is going to be like for your financial circumstances. So Tasha is going to tell us about a little bit about the different types of mortgages out there, and kind of what they mean.
Okay. There is quite a few different mortgages depending on your personal situation. One of the most common ones that most of us hear is an FHA loan. This loan is backed by the federal government. One of the pros about this loan, it really helps families that are low income or moderate income size to really not have to put a large down payment down on a home. One of the things that I want to make sure that we are all clear on, that it is a myth that you actually need 20% down on a mortgage. That is not true anymore. So with an FHA loan, a down payment normally runs 3.5% of the purchase price. So for example, if your home that you're looking at is $200,000, 3.5% of that, you can expect to put down $7,500, for example. To qualify for a FHA loan, the lowest credit score most lenders will accept is 580. You do have some lenders that will accept lowest 500, but the lower the credit score means the higher the down payment. So that's one of the pros, is that a lower down payment to get into a home. Some of the cons with an FHA loan is the fact that this type of loan is backed by the federal government, so it does require to have PMI. And you're probably asking, what is PMI?
Yeah, that's my question.
PMI is a private mortgage insurance. That is an insurance to actually protect the loan, not you. Not the insurance that protects the house. That's a home insurance. That's different. It's a loan to protect. It's an insurance to protect the loan in the event that you foreclose, that the loan will be paid for. So that's PMI. That can add about $150 to $200 to your payment, and that is a requirement for an FHA loan. One of the next federal backed loans is a USDA loan. This is a loan that is areas that are considered rural, considered by the federal government. For example, in the Austin area, some of those areas, for example, are Manor, Elgin, Gerald, some parts of Leander, and there's one spot in Round Rock that's considered USDA. So what they try to do is try to get those areas to developed. And one of the pros about this loan is that it's a 0% down payment on the loan.
Yeah.
Absolutely. With a USDA loan credit score, you have to have a 640. One of the cons with this loan is that it has really strict debt to income ratio restriction. So you're probably saying, well, Tasha, what's debt to income ratio? That is where they divide your debts into your income and see how much house you're able to afford. It shoots out a certain percentage, and it has to be very low to qualify for that home. And then one of the other cons is you have to be in one of those specific areas. This is not a loan where you can go pick out where you want to live. You would have to pick out the areas that are considered rural by the U.S. government. One of the other loan types is a VA loan. So these are a loan that is done specifically for veterans that sacrifice their service in the military. They are eligible for this type of loan program. It is also a 0% down payment, so that's a pro. You don't have to put anything down. For qualifying for this loan, it's 620. And then one of the pros with this loan is the fact that you don't have any down payment. But one of the cons of this loan is that they do charge a funding fee, and you do have to still consider closing costs, but that can be rolled into the life of the loan.
Okay, and those are also the ones that you just said, the USDA, the FHA, and then the VA. Those are the government funded loans. And
Correct.
those are the ones where you can have a lower credit score, but there's going to be more restriction as far as your debt to income ratio and then where you get to live. So if necessarily, like, you may have lower credit and be able to qualify for these loans, but you're going to have to live a little bit outside of the city, and you're going to have, you know, less bills to pay every month.
Yes, and
Okay.
that's specifically with the USDA loan.
Okay, and
Yeah.
because those are government funded.
Mhm.
Okay.
VA, they have more flexibility. They're not restricted about where they can go. They
Okay.
can go anywhere.
And then the other types of loans we would see, which is going to be where you're not really asking for assistance, right, are going to be the other types.
Right, and so that plays into the conventional loan type. Conventional loans, one of the pros about these loans is that if you are able to put down a higher down payment, usually 20%, you don't have to add the private mortgage insurance that an FHA loan or a USDA loan would require.
Okay.
So that could save you on your payment. But you always want to make sure with any loan type that financially the numbers make sense. And so to qualify for a conventional loan, credit score has to be 620. If you're in the event where you cannot put 20% down, or mathematically it doesn't make sense to put down 20%, I have seen conventional loans as low as 3% as far as a down payment. Conventional loans, some of the pros with this one is the fact that you don't have to have the mortgage insurance, so that's one of the pros with this conventional loan. The next type of loan that's not backed by the federal government is a jumbo loan. These are for your more expensive homes,
Okay.
but they do have a ceiling limit by the government. For a jumbo loan, most max is 510,000 to be exact, and then you have some areas, probably like California, where you can go a little bit higher on the ceiling limits. It's like 700,000.
Okay.
So in that situation, you may have to figure out a different way to come up with the remaining costs if your home exceeds that price.
Okay.
Or figure out different financing options for that.
Okay, so what you're saying is conventional loan, you're going to have a higher credit score, definitely going to have at least a 620, and then you're going to have your higher down payment, your debt to income ratio is still going to probably have to be good, and then your jumbo loan, which is, the only difference between those, from what I understand, is that your jumbo is going to be anything over 400,000. So it's a little bit more you're applying for than your conventional loan. So then that requires an even better credit score. Then we're looking at like a 700 credit score.
Absolutely.
So for the people out there that are wanting to live, like inside Center City, Austin, you're wondering what it's going to take. For a home in Center City, Austin, average home price is $350 right now. So you're talking about a jumbo loan. If you're talking about buying a home inside of Austin, you're looking at a jumbo mortgage loan where you're going to need a 700 plus credit score. Where if you're willing to live a little bit outside of the city, that it changes the qualifications for the loans you can apply for and kind of what your options are.
Absolutely.
An FHA loan, I wouldn't see that even meeting the qualifications for a home inside the city that costs so much.
Right, absolutely. And definitely with a jumbo loan, it's going to be a higher down payment, 10 to 20% down. And you're definitely going to have a lot of supporting documentation to be able to support your financial backings to be able to take care of this mortgage. Awesome. So it could be a little more intensive, but you have to understand the lender's perspective, the bank that's giving you the loan for your home. Especially with COVID, things are a lot more stricter, and real estate helps back up the market. So it's really, really imperative, and they're being really crucial, making sure that people that are qualifying or thinking about purchasing a home, they can qualify and they can really make their payments.
Okay. Wow. And that makes sense. Like with COVID, like it makes sense that they would want to make sure that things haven't changed, like in their income or in their job history or anything like that.
Absolutely. And then the last couple of things to point out is a lot of people ask what's the difference between a fixed rate mortgage loan and an adjustable rate mortgage loan.
Yes, and that's really important, over time.
Very, very important. So a fixed rate is just how it says, fixed, it's set, okay? So that means the life of the loan, if you do 15 years, 30 years, that mortgage payment is going to remain the same throughout the life of the loan. Okay. Now, the variations that make your payment fluctuate, a few dollars here and there, is going to be things like your taxes, if your insurance rate changes, but that's only like a few dollars on the dime. It's not much of a big impact. Your adjustable rate mortgage loans are mortgages where the rate can influx, or call a balloon payment. So those are best for people in situations that are going to purchase a home, maybe see it as an investment, or what we call a buy and hold, where you know for sure you're not going to be in that home long. That could save you on how much interest or how much money you're paying to the bank. But that payment will set low for quite some time, and then you have to really make sure you have a good understanding with your lender, because that payment will jump up. And with all the uncertainty going on with COVID right now, job situations, people moving, not moving, if that payment jumps up, it could really put you in some financial trouble if you're not prepared.
Okay, so it sounds like when you're if you're the person in the mortgage office, really deciding what you're signing for, it's those two terms are super important, because it's with a fixed rate, you can financially plan. You can,
Absolutely.
for the next 10, 30 years, whatever your loan is for, exactly what your payments are going to be, versus with a adjustable rate, which is if property taxes go up, or whatever goes up in that area, that's you're on the hook for that. Like, you may have to pay more in 10 years versus what you're paying now.
Absolutely.
Or in 5 years if you're in Austin.
Absolutely.
But okay,
All right.
So that goes over all the different types of mortgage loans, your credit qualifications for those loans. If you guys have any questions over anything we talked about, feel free to post your questions below in the comments. We are going to use your questions to make more videos. We're also going to respond to them. If you guys leave them, we will respond and answer your questions. We appreciate you watching this video so much. Again, follow us. We're going to be posting videos every Thursday. My name's Cacy with Austin Credit Care.
I'm Tasha Green with Go Green Realty Group.
And we'll see you guys next time.
Bye.